Fed Chair Jay Powell did sound a hawkish note during his testimony earlier today. He was talking about monetary policy before the Senate Banking Committee. We'll hear more tomorrow. He vowed to bring inflation down and said the Fed has the tools to do it.
We estimate the longer run neutral level of the federal funds rate to be in around 2.5%. And actually, we think it will be appropriate to raise rates above a neutral level into a modestly restrictive level, because this is very high inflation and it's hurting everybody, and we need to do our job and get inflation back on a path down to 2%.
He also declined to rule out a full point rate hike in the future. Again, the market's taking that in stride. Joining me now is Kathy Bostjancic. She's chief U.S. economist at Oxford Economics. It's good to see you again, Kathy. And his comments come as we've seen both Fed research and comments from former Fed member Bill Dudley talking about increasing odds of a recession or a hard landing here.
Yes, happy to be with you, Kelly. Well, absolutely. I mean, it's really very challenging, as Chairman Powell said, given the current environment for the Federal Reserve to get things just right, to get that coveted soft landing where you see inflation come down towards, eventually the 2% target rate, but not to see real large damage to the economy or the labor market. So that means you don't want to see the unemployment rate jump more than 0.5 percentage point. That's typically associated with recession. And you really don't want to see a contraction in, let's say, in consumer spending and overall GDP growth. So it is really tough to thread that needle. We do think there are ways that can come to fruition. So we're not in the camp that we're definitively about to see a recession, but clearly recession odds have increased.
Yeah, they've increased. And at the same time, if you just take a snapshot of the world today, you have some encouraging signs. We were just showing the 3-month 10-year spread, a good indicator of the economy. It's still 1.5 points wide. I mean, that's really strong by historical standards. And yet we've seen moderation in commodity prices, including energy. So maybe the tightening that they've done up to this point and what's now priced in tells us this economy will be on firmer footing if we, wait 6 or 12 months' time.
Yeah, that is definitely the goal. And again, it is doable. I mean, you have to get that right combination. You have to have financial conditions tightening enough, which they have tightened. The Fed has only raised rates, 175 basis points overall. And we've seen the markets really, react quite strongly to that. And because they're pricing in much more, right? The market's going in and pricing, well over, close to 4% on the Fed funds rate. So that is really the key. It's really the forward guidance that the Federal Reserve is giving is actually already working its way through the markets. And if they can tamp down on demand, and as he said, Chairman Powell said, wait for supply to kind of catch up. That is a goal, doable, but also there's lots of unknowns, right, as we go forward with supply chains and other exogenous shocks that could hit the economy.
Yeah, I mean, you guys are still in a pretty aggressive camp. You see, again, relative to the street, not relative to where inflation is. You have 75 basis point rate hikes in July and September, followed by quarter-point hikes. What is the market expecting? Because usually as we start talking about this recession question, they take out the likelihood of Fed tightening. But after the chair's comments this morning, it would seem hard for markets to do that right now.
Yeah, I think for us, we see inflation, especially headline consumer, the price index, remaining above 8.5%, and that's through Q3, so through September. So, and it may even, it may go a bit above a challenged 9%. So that's why we think the Fed is going to continue to front load rate increases, because again, inflation is the #1 enemy right now. But interestingly, the more they kind of front load, there's risks, right, for increases the recession odds, as we said, but also it gives them a chance to perhaps pause and scale back the rate increases if you start to see inflation cool down, which we do think is going to happen. So while we're more hawkish in the near term, we also are pretty optimistic that inflation will start to trend lower meaningfully in 2023.